Have you ever tried following a financial advice, but felt like it just didn't apply to your reality? This happens because most advice overlooks one essential factor: your income. Earning $35,000 a year requires a completely different strategy than earning $100,000 or more. If you've ever wondered how much you should save, where to invest, or how to balance your finances without compromising your lifestyle, this video is for you. Today, we're going to create a personalized financial plan for every income level. You'll understand exactly how to adjust your finances according to your reality and goals without falling into the trap of generic strategies that don't work. And the best part, everything with practical examples and simulations so you can visualize the impact of these decisions on your future. So, if you want a plan that truly makes sense for your life, stay until the end. Many people end up following generic advice that doesn't take their individual needs into account. This can lead you to adopt habits that aren't sustainable, or worse, overlook opportunities that could accelerate your financial growth. The first thing you need to understand is that good financial planning isn't just about earning more money, but about what you do with what you already earn. Each income level requires a specific set of strategies to ensure that you maximize your financial potential without compromising your quality of life. So, before we dive into the strategies for each income range, you need to have one very clear concept. Your financial plan needs to take three fundamental pillars into account. First, income, which is the foundation of everything and determines your financial allocation possibilities. Second, your short, medium, and long-term goals, because without a clear goal, any strategy loses its meaning. And third, your lifestyle, because an effective financial plan needs to be sustainable in the long run. With this in mind, we can now dive into the specific strategies for each income level. If you earn up to $35,000 per year, your main focus should be expense control and building a solid financial base. At this level, the biggest risk is falling into the living paycheck to paycheck cycle without being able to save or invest. The first step is to create an emergency fund, which should cover at least 3 to 6 months of basic expenses. For this, you can use the 50-30-20 method, adapted for your reality. 50% of income for essentials, 30% for variable spending, and 20% for savings and investments. If those 20% seem impossible, the key is to start small. Even 5% will make a difference in the long run. Another crucial point is to avoid bad debts, such as high-interest loans or credit card balances. At this stage, the best investment you can make is in education and skills, because increasing your income can be the biggest financial transformation factor. If you earn between $35,000 and $75,000 a year, your focus should shift to building wealth. At this point, your emergency fund should be established, and you can begin considering investments that will help grow your money. The big trap at this income level is lifestyle inflation, spending more just because you're earning more, without a clear strategy. To avoid this, an effective approach is to set aside a fixed percentage of your income for investments before spending on leisure and non-essentials. The best investments for this range include high-yield fixed-income products like CDs, certificates of deposit, and U.S. Treasury bonds, as well as the first steps into equities such as index funds and shares of solid companies. This is also the time to start planning more ambitious financial goals, like buying a house or setting up an early retirement plan. Now, if your income exceeds $75,000 per year, your focus should be on wealth building and asset protection. This is the stage where you can really accelerate your financial independence, as long as you have a clear strategy. The most common mistake at this level is thinking that high earnings automatically guarantee financial security, but without proper planning, it's easy to lose money in bad investments or pay more taxes than necessary. The ideal strategy here is diversification, including both equities, real estate, and even international investments. Tax planning also becomes essential at this stage, with strategies like private retirement accounts, IRAs, and structures that minimize taxation on your income. Additionally, protecting your wealth with insurance and estate planning ensures that you preserve your assets for the long term. Now that you understand the ideal strategies for each income level, let's see this in action. I'm going to show you a real simulation of how different decisions can impact your financial future. Imagine three people with different incomes, one earning $35,000, another earning $75,000, and another earning $150,000 a year. If each of them follows a personalized strategy and invests consistently over 10 years, the difference in accumulated wealth can be surprising. Let's consider a realistic scenario where each person allocates a percentage of their salary to investments and follows a structured plan. The simulation shows that, regardless of the starting point, consistency and making the right decisions make all the difference. Small adjustments can generate exponential growth in the long run. If you've made it this far, you now know that an effective financial plan isn't just about earning more money. It's about making intelligent decisions based on your reality. Now it's time to take action. Analyze your income, define your financial goals, and implement the strategies that align with your lifestyle and aspirations. Small, consistent steps can create a powerful impact over time, leading you toward long-term financial security and independence. The key is to stay informed, adapt your strategy as your circumstances evolve, and remain disciplined in your approach. Your financial future starts with the decisions you make today.